going back through that article around like the 20 cities with the highest credit scores, and just did a quick little Wikipedia research trying to find some correlations between, you know, the credit scoring and maybe like some of the demographics within some of those cities. Because you look at the top 5 list on there, and you know, right away the 2 that jumped out to me were like Sun City West, Arizona, and the Villages in Florida. And you know, naturally you make the correlation to the retired community that makes up the mass of both cities. And I think Sun City, I think they were actually 1 and 2, like the eldest median age of their population, with like Sun City at 75, and the Villages only at 67, surprisingly.
Interesting.
So, Rob, you know, you're looking for future residents outside of Marin County. I got some suggestions.
I lower the average credit score, Tom, wherever I go. I drag down the median, the average. You know,
I do not believe that for a moment.
well, my not that this is a show about credit score necessarily, because there are people on the call, I'm sure, who are much more knowledgeable than I am about credit score in general. But if I have a question about my account, I'll log on to my account. You know, I'll look up my username and password in the binder that I carry around, because I don't have these things memorized. And then if I'm looking at my account and there's a balance of, you know, $200, and the payment is due, you know, in 3 weeks or something, I just pay it off. I mean, like, all right, I'm here. I've taken the time to log in with my username and password, so I'm just going to pay it off. And I don't know how. I don't even know my credit score. And I've heard that you're supposed to, you know, yeah, if you really want a really high credit score, you know, if you have a balance of $100, you pay $50 and carry a balance forward, and then you carry.
Well, I'll happily chime in here and give you the insights, at least from what I had when I started out in financial services, and this is 15 plus years ago at MBNA and at Bank of America. Because coming out of college, my credit score was very low, and it was very eye-opening on what I needed to do to improve it. So in your scenario, Rob, say you've got a $200 balance, but that minimum payment's only $50, and say the statement amount due is $100. The best strategy is to pay that statement balance, because in their records, it's showing a pay in full history, and you save that remaining balance over until the next statement comes in. But that's, at the time, how they would tier their internal strategy was how many times over the minimum payment you were making month over month. And that's from an internal strategy on like what they might offer you as far as a credit line or the interest rate threshold you would qualify into. But it was very interesting stuff, and it definitely got my fascinations going with reading credit and how you maximize that in your scoring. And obviously, anybody who's gotten their credit report sees, you know, you want to keep your balances below, is it 30% at max of your available credit lines, and obviously pay on time, not be late.
I don't ever. I receive offers for some reason to increase my credit balance or my maximum line, and I always say no thanks. Yeah, I don't know. I'd probably be better off I raise them.
Right. I mean, there's a risk exposure from having that much credit accessible that you can rack up. At the same time, it does maximize your score because it lowers the utilization and shows that you're a responsible consumer and can be trusted with high credit lines. On that note, let's welcome everybody to the rundown today. Tom Gucci, Mortgage Collaborative, as always, joined by Rob Crispin, and we're happy to drop knowledge on you on how to maximize your credit score. And happy to welcome back in our president and COO, Melissa Langdale, who is on the road today, almost home, and Melissa joining in from our nation's capital. We'll kind of dive into that as we get started today. But how are we both doing this Friday?
I think to put a bow on that subject, as they say for now, that's a great way. Tom, what you explained about increasing one's credit score and how to do that is a great way that individual loan officers, mortgage originators, brokers, whoever can add value rather than just somebody going online and typing in, best mortgage rate and getting a mortgage that way. It's that personal coaching and advice and hand-holding that differentiates people versus, some nameless person in some basement in Michigan. So it's good stuff.
I'll give a
talking
shameless
about.
plug
100%.
to our partners at Trust Engine and their offering with Mortgage Coach, really designed to empower originators through like a total cost analysis to be that trusted resource in thinking about their financials and how you leverage the home as an asset, to your point, Rob, as opposed to just quoting rate, price, and term and keeping things transactional.
Right. So speaking of the in-person aspect of this business, I wanted to ask Melissa. Melissa, you are coming to us from Washington, D.C., where some members of TMC's management went, along with, you said nine lenders.
That's right.
And you've been there 3 or 4 days.
Just two. We had a full
Just
day
two.
yesterday, and then had one more meeting this morning. We had the opportunity to meet with the CFPB, with Ginnie Mae, with HUD, with FHFA, and then with Freddie Mac as well.
So
And how
before
did it
Rob
all
goes
go?
in, I got one question. Did everybody
Okay.
hit their steps goal for the last 2 days? And are your dogs barking?
Absolutely. Yeah, absolutely. I will tell you, we did Uber a little bit more because of the Canadian wildfires. The smoke that's been coming into the DC area was pretty strong at times, and so a few people did Uber a little bit more than normal. But we definitely got our steps in. Yeah.
And so you visited with which institutions?
We started with CFPB. We had an opportunity to meet with Chopra and Mark McCardle. And then we went to Ginnie Mae and had the opportunity to meet with Elena McCargo. HUD, we met with Sarah Edelman, and then FHFA, we met with Director Thompson, and then again, Freddie this morning. So we had an opportunity to meet with a lot.
Any surprises?
Yes, in some cases, and just lots of great information sharing in others. I think some of the things that we shared with all of them was probably not things they hadn't heard before, outside of maybe 1 or 2 instances. So it gives us an opportunity to reinforce some of the other things that they're hearing from others in the industry, and give our lenders an opportunity to talk about the practicality and some of the policy that is either in discussion to be rolled out in the future, or lenders are struggling with today.
So we'll come back to the substance in a minute, but I'm generally a shallow person. So in terms of the places that you went, did any physical locations strike you as opulent or in total disrepair, or someplace where you wouldn't want to be after dark? I mean, what were the buildings like, and what were the offices like?
I will tell you, Freddie Mac was impressive this morning. And the building itself is like 20 years old, but it looks like it was built yesterday. It was really, really impressive. Just behind that, FHFA and CFPB were both great. There was none where I would be, worried about being there after dark or anything, to the opposite end of the extreme. But Freddie Mac by far had the best building. and then CFPB and FHFA were right behind them.
So, everybody loves to point fingers at the CFPB and, the evil CFPB, and the CFPB has gone through different regimes, starting with Richard Cordray, who was definitely out to rub up against every tree and leave his scent everywhere. And, we had Kathy Kraninger, who had almost the opposite approach in terms of let's educate the industry and let's get a lot of input before we make any more changes. Now, since it's just us girls talking, I've heard that the current regime has gone back more towards a Richard Cordray enforcement action, big stick kind of approach. Without telling us anything that you can't tell us, is that your impression as well?
I didn't get the impression that it was as extreme as it has been in the past. He did share with us, Chopra shared with us kind of their emphasis on non-bank supervision, but that it was mainly around fintech. That there were some areas with fintech that they were just watching because there's some companies that are creating things that have never been created before, and so they just want to keep kind of their eyes on new and emerging things to better understand what it is and what they need to keep an eye on with it.
Was there
Rob,
anything? Go
real
ahead,
quick,
Tom.
it's funny you mentioned that too, because I just come across an article this week chronicling Chopra's drop in enforcement actions under his administration, where I think the stats were he's had there's 5 enforcement actions under his administration this year, following like 20 last year, where Kraninger had 48 enforcement actions in 2020, and your boy Richard Cordray had 116 in his first 3 years in the administration. So interesting contrast between 3 leaders.
Yep.
Now, that only averages out to about 40 or 50 a year, Tom, for good old Richard. But anyway, that aside, so getting back to the CFP, or keeping with the CFPB vein, Melissa, did you get the impression that they were open to what you had to say, and that your visit was beneficial?
I absolutely did. We were originally told that we were just going to meet with Mark McCardle, and Chopra May stopped by, and he ended up being with us the entire time. It was fantastic, to be able to hear directly from him, and he stayed and listened to us, and we had some great discussions. And
did you also get the impression that he's pretty knowledgeable about mortgage banking in general?
I did. There weren't any times where I felt like, that was not the case.
Yeah.
We didn't dig into like, hey, Chopra, how do you calculate APR? But
no,
Didn't send him a self-employed borrower income count.
I feel like that's a skill that most mortgage professionals should be able to do without the need of an LOS, but just that's the old school in me.
There you go. And what about I think you mentioned, or maybe you mentioned before the show began, that Fannie Mae was not the people that TMC and everybody would have met with. The Fannie Mae folks were out and about or on vacation or whatever. But you did spend time with FHFA and with Freddie Mac. Any, did they give you any inkling as to what might be in the near future with regard to, pricing? Or I'm sure they're not going to veer from their affordable housing, underserved market,
Yep.
thrust.
Yeah, Freddie spent a lot of time talking to us about kind of their requirements that they have to meet, fair housing fair lending requirements. And so, I that part's not really changing, or not really surprising. One thing they did share with us that I thought was really interesting, there's a couple of providers. So in our conversation around affordability and kind of trending of income levels with housing availability, and they have kind of created a data profile for like ready homeowners, like people that could come to the market and be ready. And so they kind of trended that with kind of what's affordable in the marketplace, kind of by state, and spent a lot of time with us going through that. But in that conversation, what was really cool is they started to kind of take that data and put it against like what's holding people back from being able to purchase. And in some cases where the markets are very affordable, there also is a challenge with the customers having enough cash to close. And so one of the, obviously the solutions for that is down payment assistance, right? And so they shared with us that there is going to be, and I don't know when, they didn't share, kind of a date on this, but they did share that there is going to be kind of a data connection, that there's, for those of you that have checked this out from a DPA perspective, there are some providers that like give you a tool where you can kind of search which DPAs are available in which markets for those homes. It sounds like Freddie is actually building a data connection for that, so that in the future, you'll actually be able to have a finding on your LPA, readout that says, hey, this home is eligible for, similar to what you see now with, hey, this is eligible for home ready or home possible. It would be the same thing. This home is eligible for, or this borrower is eligible for this level of DPA funds, which I think is really interesting. So they have a product that they coined, I think DPA One was what they called it, that they're working on to come out. So I thought it was a really unique solution for them to try to meet their kind of affordability goals, and something kind of new that everybody may not know about yet.
Did they talk about any software focused on repurchases?
We spent a lot of time talking about repurchases.
I was
that's
teasing
like
there a little bit
with some of our.
Yeah, obviously repurchases, buybacks are a big topic.
Yep.
They were a big topic in New York, and the agencies have claimed that, oh, it's nothing. We're not doing anything unusual. We're just playing catch up with the huge volumes that we saw in 2020 and 2021. I've heard other things from lenders, but what were your discussions about revolving around repurchases?
What they shared with me is they do recognize the challenge for lenders. They shared exactly the same thing that they shared at secondary, which is what you just talked about. But they also shared that they're creating some more processes for for their team, so that the repurchases that actually go to lenders will be less. And one of them is just that second level review on repurchase requests. So if somebody, flags a file for repurchase, it actually has to go through a second level of somebody taking a look at it before it gets sent off to the lender. And they're estimating that this is going to reduce the communication around repurchase requests by 10%. So they're trying to catch those ones that are just human error, asking. We had an example where they had asked for a HUD-1, and just clearly an associate that just wasn't fully trained on what was what's going on currently in our industry. And so we shared that feedback with them, and they're very they're kind of hopeful that this extra level of review will help to reduce the amount of requests that are actually the amount of noise that's around requests, right? Those kind of false requests that end up getting worked out over time.
Yeah, well, as sounds like their hopes and the industry hopes match in terms of reducing some of that. And I think from the lender's perspective, what I've heard, you have issues where the borrowers are making their payments and have made their payments for 2 or 3 years without fail. And now they're having to repurchase a loan because of, the income might have been incorrectly documented or calculated or something. And so suddenly you're buying back a $400,000 loan at $400,000, then having to resell it at 70 cents on the dollar And it's, it's a hit. It's a hit.
It,
So
it's a huge hit, especially when the interest rate on that loan originally 2 to 3 years ago, right, was in the 2s or 3s. And so it can be a really, really big hit for lenders. We did ask them about that. As a matter of fact, one of the things that we pushed on was, or we, offered as a solution, was to just open up AUS findings longer. So if there is a difference in calculation and income, our lenders have an opportunity to actually correct it in a timely manner, instead of having to go back through and repurchase because they just can't run AUS anymore. Which, there's a lot of complexity around that, and logistically making that work, but we seemed open to exploring it at least.
well, that's good. Any talk with anybody about the tri-merge, bi-merge, the move, the shifting that we're seeing in the credit world?
Yeah, that's such a great question. We had so many discussions around it. And really, I think most lenders' fears, not just, with TMC, I'm sure, but most lenders' fears are, hey, if FHA is requiring this and Fannie and Freddie are requiring one thing, right? What about FHA and VA and USDA? Like, what if mid-process I have to change programs, and then I don't have the same credit scoring requirements that I do, for Fannie Freddie as I do for FHA, VA, and USDA? And so we shared a lot of feedback around that. They do recognize the challenge. We talked to FHFA, we talked to Jenny May about it, we talked to HUD about it. And they do recognize the challenge, and it does sound like they are working together to ensure that the timing of the rollout will be consistent across all agencies for lenders. So that was really, really good news for us.
That is good news. Yeah, obviously FHA and VA. In fact, my commentary tomorrow, I have today I had information. It's just, we are constantly reminded that FHA and VA offer programs which typically maybe borrowers might not qualify for Fannie Mae or Freddie Mac. It's a different, it's a different game and a different target set of borrowers, and they seem comfortable with that niche. And so it'll be interesting to see if this changes, if this changes things, because as you know, and everybody on the call knows, when one agency makes a change, it has a ripple effect throughout the rest of the industry. And whether other institutions get adversely selected to or not, or you do because you make a change in your guidelines and suddenly you get all these loans that you may not have wanted. The same with credit guidelines and credit scoring and so forth. So I'm glad that was a topic. So we talked about repurchases, we talked about credit, we talked about the shape of the buildings we're in. What else did TMC and the lenders, what other information did you glean from your time in Washington, D.C.?
We spent some time talking about trigger leads, particularly with CFPB and FHFA. They had some questions about it, and we had some feedback for them. This is we've had a lot of discussions, I think, as an industry around this, right? And consumers, there are lenders that are for it, obviously, because it's what's driving leads for their business, and there are a lot of lenders that are very against it because it's causing confusion with consumers, and it's in a lot of cases a big challenge for lenders to be competitive when things like that happen. It's compressing margins for a lot of them, which is not necessarily a bad thing from a consumer perspective, but we all know kind of how the lending world works, and those things aren't always as simple as they seem, right? It's not necessarily that the consumer is always going to walk away with a better price in those deals. And so, we had a lot of discussions around trigger leads. We also had some discussions around LO comp. Over the years, there's been a lot of conversations around, wanting to have some layer of flexibility with it, right? if there is a need to get super competitive for a loan officer, there is a bond program, for example, or, these products that just naturally have really thin margins, paying a loan officer the same for each one of those scenarios is a challenge for some lenders. And so we had some good discussions around LO comp and, and what our lenders are seeing there as well.
Yeah, I think going back to the trigger leads, you're right. For example, the MBA has members who love trigger leads and members who hate trigger leads. And I've published in my commentary several times how to, the opt out, 1-800 opt out and so forth. And there are loan officers who make a point of that. There are also originators who point out that it takes a certain amount of time before you can really opt out. And, until then use soft pulls and so forth. And I remember way back when the CFPB made a point of telling consumers, look, shop around with different lenders, try to get the best price out there among several lenders. And of course, what that does is cause all those lenders to run credit reports on borrowers who are out there trying to get the best rate. And that impacts their credit scores, of course. So it's not a simple situation by any stretch.
That's right. It's not.
Regarding LO comp, is that something? I assume that you took that up. I mean, were you talking with the CFPB about LO comp or FHFA or? Yeah. Go ahead.
We were talking to the CFPB about LO comp. And I think they recognize that the original kind of foundation for the regulation around it, we were in a different market and had different needs. And we're seeing different things, at that time as well. So I think there's, within reason, open to, to looking at solutions. But I think it's still going to be a long journey for anything that, really solves the issue.
Yeah. And what else? What was the general mood like in terms of when you were stopping in to see the FHFA or CFPB or Freddie Mac? Was the mood good, or do they realize kind of what we're going through as an industry?
They all realize what we're going through as an industry. Absolutely. I think the mood as a whole was very realistic, if for lack of a better words. They were all very cognizant of the challenges that lenders are facing today.
Well,
yeah. So go ahead, Tom.
I was just curious too. I guess I wanted to give a shout out to the Don of the Mortgage Collaborative Lender Board, Stephen Milner, who dropped in the chat that by their own admission, the GSEs have been very proactive in pursuing repurchases due to their prediction that in the current environment, a significant number of IMBs may either sell, merge or sell entirely, and that if that should occur, then their concern is that they wouldn't be able to recover those potential losses out there. So appreciate the insight, Stephen. I was curious, Melissa, with the group's meeting with Director Thompson, what kind of the tenor was around attorney opinion letters, because I continue to see those pop up, and another lightning rod issue in the industry right now.
Yeah. We discussed kind of the potential savings of attorney opinion letters. Sorry. And there is some pretty strong data that it could save consumers, anywhere from $900 to $1,000 a transaction. And so, I mean, we did have some discussions about that, but we did not spend a lot of time on it. I think that lenders, I think while they understand and support the cost savings to the consumers on it, I also know lenders that are struggling with operationalizing that too. And so, but there is, from everything we discussed with FHFA and our lender members, there is some pretty significant cost savings that consumers will see with those.
You're seeing, lenders look to implement that right now, just in anything they can do to bring down costs of origination. And I just want to circle back. We got some commentary in the chat as well too, just around the trigger lead timing, and Tracy King, favorite of ours, mentioned that there's a period of time the borrower has to shop around, in quotes, where multiple inquiries won't impact their score. And so I had to ask her on the fly, and she mentioned with Equifax TransUnion, it's 45 days. With Experian, it's 14. So Tracy, thank you for dropping the knowledge. And Phil Kakafka, Rob wanted to know he loved your grass pricing analysis and the commentary this morning.
Well, and it's true. It's true. I made fun of the CFPB. Sorry, Melissa, I know they're your new best friends, but I made fun of the CFPB in terms of they spent, I don't know how much money they spent on this study that says that consumers can actually save money by shopping around for mortgages. And I'm thinking, how much money do they spend on a study to find out that different companies have different structures that create different pricing in the front end? And are they going to do the same thing with gas stations or refrigerators or sub-zero, ranges? Or, I mean, yeah, there's different prices out there. And I grew up in an era of buyer beware, shop around if you want, or there's a convenience factor, et cetera, et cetera. So the CFPB publishes this study that says, oh, different lenders have different prices, so shop around. And it's, yeah, I mean, duh. I don't know. Don't get me started. I'm already ranting here.
For the record, I did not say that CFPB and I were BFFs.
All right. I know. I get it.
I'm just making it salacious on a Friday, but I think, I guess, Melissa, was there, I want to give a shout out to ArchMI, our longtime partners who hosted the group for dinner upon their arrival on Wednesday night. Greatly appreciate the group there. And didn't want to see, maybe if there was any final takeaways and kind of closing the loop on the DC trip that you wanted to share with our audience.
No, it was a fantastic time with our members, just giving them everybody an opportunity to have their voice heard. And the reception at each of the agencies was fantastic. So really, really positive experience for everybody, and looking forward to doing it again in the future.
Awesome. We want to make that a recurrence, and certainly appreciate the government agencies making the time for our members out there as well. We had some headlines this week, not many great ones. I guess on a slightly positive note, non-bank lending and residential construction jobs ticked up for the first time in 12 months. But to be fair, because Rob knows, not a fan of salacious headlines, that residential construction job increase only 0.8%. So paltry at best, but some silver lining out there. And then flip the script on more gloomy headlines was all cash home buying hitting its highest level since 2014, where 33% of April's purchases were made in cash, up from 30% in April of last year. And not to put you both on the spot, but I mean, can't think of any silver bullet out there that can switch the pendulum back outside of creating, more inventory or, maybe incentive for the investor community to, sell off properties or tax incentives, as you and Rich used to discuss in the past on here. But any thoughts there? Would like to pass on that one.
I can't think of any. I think the public continues to motor on, and the question is, for every one of those purchases, maybe there was a seller, and it's a matter of finding out, why they sold and where they're going, and if they need help. And just, a lot of loan officers are telling me now they're doing what they can to stay in front of the realtors and just reminding the realtors that they exist. And just that's all that you can do in some of these cases. And some markets obviously are stronger than others, but inventory continues to be very low. And so not only are IMBs competing against all cash buyers, but I shouldn't say competing, but not only are IMBs having to deal with all cash buyers, but also dealing with credit unions and banks who are out there as well, and the broker community. So it's a very tough environment. I don't have any sugarcoating or any any great news. I don't know, Melissa, do you have any thoughts on that? I mean, you're out there competing. What
Ditto.
I hear you, audience. I tried, but some of these issues are bigger than the rundown audience can necessarily solve for. And I think what's unfortunate too is saw an article today from Black Knight's Mortgage Monitor, just heightening the affordability struggles that come in tandem with that, showing that it now requires 34% of the median household gross income to make a monthly P&I mortgage payment based on 30-year fix, with 20% down, which is what we strive to line up home buyers with, and completely flies in the face of the old 28% rule. Saying not to exceed 28% of your gross monthly income towards a house payment. And now we're saying the average is 34%. So, scary prospects too for middle income homeowners trying to make ends meet or get into the marketplace. That couple that with our normal inflationary concerns and just skyrocketing home prices, and it tough sledding out there really for consumers trying to get into home buying.
Yeah. On that
positive note,
right? Tom, what are you doing this weekend? Tom, tell us what are you doing this weekend?
I'm going to look for some new Debbie Downer material for
good.
No, this weekend I will be consoling my son who had his last day of first grade and is sobbing in the other room from missing his teacher already. And I'll probably get up extra early Sunday morning to root for my man Novak Djokovic in the French Open finals. That's the highlights on my end before I head out Monday morning to San Diego for Total Experts User Conference.
There you go. Why don't you show your soon-to-be second grader Van Halen's teacher video and tell him this will happen to you.
My wife's an educator. It's quite the theme song in the household, which she does not take too kindly to.
No, I would imagine.
What about
not.
you guys? Anything fun this weekend?
Yeah, I'm gonna watch that video a few more times. No, gonna play some hoops and head down to the Central Coast of California for some fun and R&R.
Line that up with the White Snake video too from that.
Right. There you go. Melissa, what are you doing there in Austin, Texas?
I am taking my kids. We're going to do some pool time on Saturday, and then we're doing family golf on Sunday. So I have 12-year-old twin boys, for those of you that don't know me, and we're going to take them out on the course with us and do a little family golf on Sunday. So that's our fun.
Do those family golf engagements get pretty heated? Somebody was Wacoma sore loser? No, that's good. It's a frustrating game.
I always win though, so no.
Yeah, we don't need more people flinging their clubs into lakes when they don't do well on the golf course. I've heard rumors of that, but anyway, that aside,
we just have fun. That's it.
You gotta release your frustration somewhere, but. On that note, I'm going to be out of the mix next week, but you're in good hands with Rob and Melissa, and you guys, no shortage of economic indicators next week with the latest CPI and PPI data released Tuesday and Wednesday, just as the Fed's going to be meeting to discuss another round of potential rate hikes. I know we've talked about that ad nauseum, but it seems like the consensus is either a quarter point in June, or maybe they kick the can down the road a month to July to then add another quarter point and see where inflation shakes out from there. But certainly plenty to glean on for economic indicators this coming week.
All right. Well, thank you everyone for tuning in.
Have a great weekend.
Thank you
everybody.
guys.
Bye.